is China's trade problem affecting U.S. stocks? You may have seen, although you probably didn't see because it's not the biggest data release of the month or of even the week usually. Chinese trade balance came out last week, and it came out lower than expected, which is to say that China usually operates at a trade surplus. They export more than they import, creating a net positive trade balance. And the headline number comes in at 80 billion, which, looks good. And then in front of you here, we just have the export data itself. And yeah, don't mind the dips in the data. It's just a little bit of a funky data set from the customs office in China, presented here by Trading Economics. And you might think, wow, okay, you've got an economy here that's operating at a net positive trade balance of 80 billion. That's great. That's got to be great, right? And you see this, exports chart, and they're operating, they're sending out hundreds of billions in export every year. This is great. This data is down significantly from last year, and this is what really brought some pessimism to the Chinese stock market, but we'll talk to the knock-on effect from this in just a second, which might not be what you think it is. There's some really interesting cause and effects built into this, but just to get back to the actual number, down almost 20% from last year, the trade balance is, as of this July number. And yeah, though they're still operating at a better export perspective than they were in 2018, 2019, even 2020, you look at the data relative to 2021 and 2022 and think about what's been going on in the US in the same time span. We had the dip in 2022 in a bunch of US metrics, kind of coming down from that huge last part of 2020 and 2021. Remember, pandemic happens early 2020. U.S. stock market really rebounds well, and so do most global markets. Now, since 2022, here in this year, a lot of U.S. data has really rebounded, and the U.S. stock market has really rebounded from the inflation fear we saw of last year. China, not so much. You can see that this trend has just continued to go lower and lower month over month since that peak in the later part of 2021 and in 2022. And you can see that year on year down almost 20% in this trade balance. Now, what does this mean for U.S. markets? Well, this is going to get a little bit textbooky for just a second, and then we're going to get right back into some trade data. But less Chinese trade could bring less demand to U.S. Treasuries. You might have read in the past, every once in a while they'll publish, some hyperbolic piece of how China is dumping its U.S. debt and it's going to do X, Y, and Z. And that's a little bit sensationalist for my taste, but there is a pretty direct theoretical cause and effect here, whereby, when exports are higher than imports in China, positive trade balance, which they've had, then China has a surplus of US dollars, right? Oh, we're sending more goods out to the US than we're importing from them. And so from all those goods that we're sending to the US, we're getting a lot of US dollars in the door. And if we then convert those US dollars to renminbi, then that will cause the US dollar to, in theory, depreciate and the renminbi to appreciate. And this is the kind of like organic standpoint for economics for exports and imports, which is that should essentially lead to a higher valued renminbi, a depreciated US dollar, and bring less exports to China, right? Oh, well, now Chinese goods are more expensive. And so we're not going to import from China. Thus, China's not going to export as much. China doesn't want that, right? Their economy is really, really heavily dependent on exporting goods. And so they don't want that less exports piece you see in the middle part here. And so what do? They buy US Treasuries instead of converting their US dollars to renminbi, keeping that renminbi relatively weak and not pushing its value higher and thus pushing their exports out the door. And so in theory, if the trade balance lowers, they're not exporting as much, they're getting less US dollars in the door, then they have less of a demand for US Treasuries, and US Treasury prices, in theory, can fall from this. And before we get to those US Treasury prices, here is a graph of the US Treasuries owned by China from the US Department of the Treasury and Investopedia here. And you can see that this value peaked around 2010 to 2012, and it's been a pretty steady decline since then. And then you look at the last couple of data points here from 2021 until present, and you're seeing a pretty precipitous fall. And now we're down to China, as recently as a year ago, was owning more than $1 trillion in U.S. debt, now down to $860 billion as of the start of 2023, and trending in the wrong direction if you are speaking to U.S. Treasury demand and U.S. prices staying higher. And you can't help but tie in the fact that we've got this poor Chinese trade balance number coming out as of last week, the knock-on effects that theoretically this could have to going from Chinese exports to Chinese U.S. dollars that they hold to demand for U.S. Treasuries coming out of China. And then you throw on top of it the fact that the U.S. 10-year Treasury note, which is pretty much the benchmark for U.S. Treasury debt, near its lowest price since 2007. Now let's go back and forth again really quick here to look at the timeline of the highs in terms of Chinese ownership of U.S. Treasuries and the lows in terms of U.S. Treasury prices. And you can see that starting in that 2008 range, China starts to really ramp up their game of about, $500 billion all the way to $1 trillion pretty quickly in about a 3 or 4 year span. And that demand from China is happening at the same time that U.S. 10-year notes are climbing from about 2007, 2008, around $105, $110, all the way up to $130 and above by 2010, 2012 period. So again, this isn't a one-for-one type of trend here, but you would have to say that it is correlated to an extent, given these different timelines and the fact that our U.S. 10-year Treasury note is near its lowest price in more than a decade. And that obviously means that vice versa, 10-year yields are near their highs in more than a decade. And this comes to, how does this affect the U.S. stock market? Because if I'm reading about this in a textbook, no one has talked about U.S. stocks yet, right? This is Chinese economy, Chinese exports and imports, what that means for the Chinese stock landscape and companies that are operating out of China, and how that affects U.S. debt markets. But how does that affect U.S. stock markets? And it's very, very nuanced. Of course, if this was a different time that this was occurring in China relative to the U.S. economy, it might mean something different. It always does. Every year is a different story. But this year's story, what's been a major piece has been the regional banking crisis around high interest rates and how regional banks got into a bunch of trouble back in the early part of this year around the fact that they were taking money in at a low interest rate environment and investing it for a longer period of time, let's say 10 years, at 1.5%, 2% when interest rates were still relatively low. Interest rates rise higher, their customers want their money back. And now they've got the money locked up for, let's say, an example, a 10-year duration at 2%. And now interest rates in the short term are higher than 5%. And so that whole mismatch caused a bunch of turbulence for banks. And thus, the correlation between 10-year notes and KRE, which is a regional bank ETF, went positive for the first time in a while in the early part of this year, which is to say that when Treasury note prices fall, recently, regional bank prices have also been falling. And so this is that knock-on effect in the US stock market from China, which is China has fewer exports. China has less US Treasuries to buy. US Treasury demand falls and US Treasury prices fall. Regional banks trend lower with these falling prices because interest rates are rising and bringing more turbulence for these banks that we saw in the early part of this year. And you can see that in the early part of the year, the correlation went to positive, like I say, for the first time in years. And then the last couple of months have been relatively calm, right? Since about April until July, everything kind of went back to normal for a little bit. The regional bank crisis story went away. Interest rates looked like they were just going to stay around 5%. But recently, and you look at the correlation chart, the correlation went back to positive as interest rates in the US have now gone back to highs. And like I bring up the chart again, note prices have gone back to lows. So a few different things going on here in tandem with Chinese trade balance being 20% lower year on year, or about 20% lower year on year. Now, of course, you throw in a couple of other reasons for US interest rates to be high, and you could see this regional bank crisis really reemerge. We've got the stickier core inflation. We've got the food and energy inflation. Now, it was up from 3% to 3.2%, but if crude oil continues to run up and, you know, any of the ag markets rebound, energy and food rebounds, and that inflation reemerges, that could cause the Fed to have to hike interest rates further. And then the Fed has also just been talking about how Fed Chair Powell at a recent press conference was talking about how he intends to keep rates higher for longer than maybe people think, as the market is projecting interest rates to fall in the next year. The Fed funds rate futures are projecting to see, you know, interest rate cuts in the next year. And if Fed Chair Powell doesn't think that that's going to happen, you have higher interest rates coming from that. And then also, this wasn't the biggest story in the world, but Japan has, you know, lifted their threshold on their 10-year interest rate from 0.5% to 1%. And 10-year interest rates in Germany and Japan and these global places also rising. You've got the rates rising abroad. Then you throw in this weaker Chinese demand, and you might see interest rates not only top out at 4 or 5%, but get even higher than that. And that could have adverse effects for regional banks and stocks in general here in the U.S.